Hey, Fintech here, and let's get straight to the point. SoFi is a growing fintech company that's adding tons of new customers, making more profit than ever, and keeps launching new products that their customers love. But since that's what everyone talks about, I've gathered the 7 secrets that are driving SoFi's future success that I haven't seen other people talking about, but could be the reason SoFi becomes a multi-bagger stock. And number 5 is a massive change for anyone who's been investing in SoFi for more than a few months that's kind of flown under the radar. So let's start with the first reason that I personally am investing in SoFi stock. SoFi started out as a student loan company, but they've long since evolved into a true fintech company, creating innovative products and services that make their customers' lives easier. Let's use the SoFi app as an example. While the company still has a majorly profitable lending arm, their growth engine has shifted from lending to their app and similar services. Okay, so let's map out what that means in a series of S-curves. We've probably all seen these charts before in S-curve maps innovation over time. So you start by investing a bunch of money in developing a new product. It eventually takes off and makes you a bunch of money, and eventually it reaches maturity and growth caps out. You can also map the growth of entire industries on an S-curve. Now, most banks like SoFi will have a period of rapid growth before they plateau out. But SoFi is doing something different here that looks more like a tech company than a traditional bank. If this is the S-curve SoFi's lending business is going through, well, then this is the curve for SoFi's investing app, and then this is the curve for their financial services, and on it goes. So in this way, SoFi keeps growing even as individual products cap out. And we can see this in action in SoFi's earnings. Here is SoFi's growth in their lending business. We can see that there's still growth, but their number of new products sold is slowing down. And here is their financial services business, which includes things like the SoFi app, SoFi Credit Card, and SoFi Checking Account. We can see the growth is way higher here today. So when I see reports that SoFi's lending growth is slowing, I just want to show them this chart. SoFi is not just a lending business anymore. They're really 3 businesses in one, and their financial services are now the growth engine of the business. But you don't become 3 businesses in one without a strong leader behind you, which leads us to reason number 2 for investing in SoFi, which all kind of centers around Anthony Noto, the CEO of SoFi. Let me tell you, as an investor in SoFi, I didn't realize how important this man has been to SoFi's success until I started deep diving him for this video. Like, obviously he's the guy in charge, but I genuinely don't think SoFi would still exist if he hadn't been steering the ship. So here's the 10-second life story of our steadfast skipper that every SoFi investor should know, and then we'll get into why Noto is SoFi's secret weapon. So age 18, Noto is an all-star linebacker at West Point. Age 25, graduates Army Ranger Special Forces School. Age 31, gets an MBA at the top business school in the country and gets picked up by Goldman Sachs. Later becomes the chief financial officer of the NFL. He has a stint as the CFO of Twitter before eventually taking over running that entire company. And then, and this is where things get crazy, he moves into a company whose CEO had just been ousted for harassment, turns the ship around, helps the company go public, and then in the midst of a global pandemic, shifts their business, which used to focus on student loans at the time, yet not a great place to be in 2021, into a whole new business just to keep the company alive. Was that 10 seconds? The point is, SoFi is going to remain a place of constant change as it grows into a mature company. And having someone with both the leadership skills and the industry connects that Anthony Noto does, you can't underestimate the value of that, especially given how much the business is changing even now. We saw them shift from lending to financial services, but there's an even bigger fundamental shift happening, which is also the next item on our list, and in my opinion, could be the single biggest thing I see the market missing about SoFi. And by the way, we're still trying to get my Instagram bigger than the scam accounts who keep trying to sell people crypto in the DMs. It's a close race, but I think we can pass them and hopefully prevent anyone else from getting confused who the real account is. It's this one, by the way. I'm posting daily market news there, and I share behind the scenes research and thoughts on stocks pretty regularly. I'll link it below, or you can just scan this code to give me a follow. And so I think anyone watching this video is probably aware that SoFi is not just an app, but going beyond that, they aren't even a B2C company anymore, meaning they don't only sell directly to consumers. With their acquisition of the Galileo technology platform, SoFi transitioned for the first time into selling products to other businesses, not just to consumers. And this is still early stages compared to where the company is going. This chart shows SoFi's playbook when launching a new product. build awareness, drive down costs using technology, pass those savings on to consumers, which makes it so more people want to use it. You can then drive mass adoption and then democratize access by letting other businesses launch the same product using SoFi's technology backbone. We'll get into how they're doing this and what it means for the long-term stock price in a minute, but in the short term, what matters is the B2B business tends to be much more stable and predictable than trying to sell directly to consumers, which is why I tend to invest in a lot of B2B stocks. And that technology platform that SoFi is building leads us into the fourth reason which I think the market is undervaluing, which I'll summarize in one word: Technisys. SoFi's technology platform isn't really a secret, even if the market is missing a lot of the benefits of the B2B market, but many investors already know that SoFi has been building up a backbone of technologies that they can use to make their own services more efficient, cheaper, and more desirable to their users. They've done this through two major acquisitions: the Galileo technology platform in 2020, which is a payments processor that both runs SoFi's business as well as services other major apps like Robinhood. But many people don't know that SoFi acquired a second company in 2022, which hasn't really shown up in SoFi's products yet. So check this out. In SoFi's latest earnings presentation, they had a whole slide dedicated to Galileo. And in their last earnings call, they talked about Galileo 4 separate times. But discussions of their other $1.2 billion acquisition of Technisys hasn't really been in the news recently, and SoFi hasn't talked about it. So what's going on? Did they just throw away $1 billion for no real benefit? It's kind of what I thought when I first started looking into this, but then I found something. The reason Technisys is flying under the radar is the same reason it's going to have such a big impact on SoFi. Their technology is what's important. SoFi has stated in their earnings that they do not even measure how many accounts Technisys has, as they are not concerned with Technisys as a business. Contrast that with Galileo, which has its own CEO on SoFi's leadership team and almost runs like a bolted-on independent company. When Technisys' CEO, Miguel Santos, won Entrepreneur of the Year back in 2023, the CEO said his company is helping to bridge the digital gap with his highly scalable execution machine that banks can leverage to create multiple products. So Technisys is allowing SoFi to basically offer banking as a service, where any company can now go to SoFi, borrow SoFi's banking license, and use their technology to spin up their own bank basically overnight. How many universities or startup fintechs or even international corporations would love to be able to spin up their own branded bank in a matter of weeks? Technisys and SoFi's technology platform is what will allow them to do that. Kind of like Amazon created Amazon Web Services, SoFi wants to become the AWS of fintech. And even though Galileo gets a lot of the press, Technisys is driving that technology. But that leads us to maybe the biggest secret that the stock market is missing about SoFi. SoFi isn't a meme stock anymore. A meme stock, a company that has gained a cult-like following on social media, often resulting in the stock becoming overvalued relative to the fundamentals. So let's try to answer this question once and for all. Is SoFi a meme stock? Well, look, SoFi has some meme potentials in its origin as a SPAC. Meme potential, that's probably the number they should use in earnings. So SoFi didn't go public via an IPO or an initial public offering like most companies do. Instead, it went public via a SPAC, which is a special way to take a company from private to public by merging the then private SoFi with a public shell company run by famous, or maybe infamous, investor Chamath Palihapitiya. So this was the tail end of 2020, when Chamath was taking tons of companies public in this way, most of which didn't turn out too well. But long story short, many of the SPAC stocks, as they were known, generated a ton of interest from retail investors and social media, but they often didn't deliver on the value they promised. But one stock was an exception. Unlike other SPACs that were dogged by claims of unsustainable business practices or outright fraud, SoFi had real customers, real growth, and real potential. And that's why it was bought up especially heavily during the SPAC craze when it first went public, in large part driven by retail investors. But SoFi is a very different company now than it was 3 years ago, and people making memes about a stock does not mean the price is primarily driven by irrational exuberance. And the majority of SoFi investors today are a mix of insiders and big institutional investors like hedge funds. Retail investors and other public companies combined only make up 44% of SoFi's ownership, which is actually less than a company like Apple. So is SoFi still, quote, a meme stock? Well, even though people like to discuss discussed the stock on Reddit, and the memes are still strong, nothing about the actual company or their stock price indicates that it's a meme stock. Now we'll hit on number 6 quickly and then go straight to number 7 because YouTube likes 7 secrets more than 6. I kind of broke it down into 2 parts, but the second part is what's most important for SoFi's stock price. So number 6, SoFi is an expert at handling change. Whether it's changing CEOs, pivoting from student lending to personal loans and then later to financial services, or completely entering a new business with their B2B platform, SoFi is not the stuffy, slow-moving bank of our parents' time, and they have proven themselves as a company that is continually willing to reinvent itself. And considering the market right now, I'll take a company that's willing to adapt and overcome any day. Which takes us to the most important factor for investors who want to see an increase in SoFi's stock price over not just the long term, but maybe the short term as well. SoFi might be a value stock at its current price. Let me just show you what I'm seeing and you can decide for yourself. So there are lots of metrics you can use to value a company: price to sales ratio, PE ratio, but the one that I want to look at is the price to book value. This is basically the total value of the stock divided by what the raw assets of the company would be worth if sold off for parts. This is basically a measure of how much the market cares that the company stays together and operates as one whole. So this will differ a lot depending on the industry that a company is in. And here's a chart showing all the different industries. It's a little long, but I want to call out 3 specific industries that SoFi plays in. First, you have banking, but small regional banks tend to not have a lot of excess value since they just hold money and they're fairly easy to copy, while financial services has a price to book value of over 3, meaning for every dollar in assets that this kind of company has, the company is worth $3. And of course, software will be much higher than that because a lot of the value is in the people and the processes behind the software and not in physical inventory or cash. So let's look at SoFi's price to book value. It's currently sitting around 1.2, close to the cheapest it's been and well below the average for the financial services industry average of 3, which, as we talked about, financial services is quickly becoming SoFi's primary growth engine. But just for fun, let's see how that compares to companies in similar industries. Robinhood is the most popular investing app, and they boast a price to book value of 2.8, rising rapidly over the past year. And the massive bank JP Morgan has a price to book value of 1.8. And this is probably a better reflection of the mix of banking and financial services to what SoFi is ultimately going for. So if SoFi was able to hit a similar price to book value as a big bank like JP Morgan, they didn't grow their assets at all, they just saw their valuation rise to match the industry, they would see a 50% increase in the stock price. And if they were valued more like a fintech like Robinhood, they could easily see a 100% or a 200% increase in price. I'm sure I glossed over some important parts of SoFi's business, so let me know in the comments what you think I may have missed. And YouTube's AI thinks that you would really enjoy this video next.